I think there is a potential for earnings to drive this market to 60,000 on the Dow and 8,000 on the S&P 500.
The stock market could rise 50% from now to the end of the decade. That's the base case scenario put forth from Yardeni Research. Today, we have Eric Wallerstein and Dr. Ed Yardeni joining us to discuss just that. I'm Ed D'Agostino, and this is Global Macro Update. You continue to amaze and surprise people with your with your predictions of a market that just continues to go up, and you've been so right. And we live in this financial analysis world where people tend to gravitate towards negativity. The bear case always sounds more cerebral, and yet you guys have nailed it with your what you call your roaring 20s scenario. Just set the stage for what you mean by the roaring 20s and the probabilities you assign to it.
Clearly, the 2020s rhymes with the 1920s, so we can start there. But beyond rhyming, we know that history doesn't repeat itself, and occasionally it does rhyme. And there are similarities between the 1920s and the 2020s. The 1920s, a couple of years before that, we had the Great Wars, they called it back then. Then after the Great War, which was World War I, we had the Spanish flu. And then in 1920, we had what they call a depression. Back then, they didn't use the word recession for downturn, so we don't know how bad it was. But it was pretty bad. And so anybody at the beginning of the 1920s who thought about the economic outlook must have been pretty depressed because nothing to be optimistic about, and yet it turned out to be the roaring 1920s. And that was because we had all these technological innovations, the automobile, washing machines, electricity, natural gas, all these things dramatically improved the standard of living and the growth in the U.S. economy. And a lot of that was based on productivity that was fueled by technology. And we think the same thing is happening in the current decade. There's the problem we have today is the labor shortage, and companies are responding to it, we think, by using technology to increase the productivity of workers, not to get rid of workers because they are in short supply, but to augment their ability, not just to the old way of increasing productivity was to increase brawn, the physical strength of humans. This is also increasing the ability of the brain to be augmented by things like artificial intelligence, robotics, automation, and so on. So you put it all together, and we think we're in the early phases of a productivity boom that'll last through the end of the decade. And if that's the case, productivity is sort of fairy dust. It boosts real GDP. It keeps a lid on inflation. It allows wages to rise faster than prices, and it's great for profit margins. So there's nothing bad you can say about it. And that's our 60% probability scenario. That's the one we think is most likely. And then, since we're talking about decades, we can't dismiss the possibility of a 1990 scenario, which is too much of a good thing, that the market gets too excited about the roaring 2020s and discounts everything now. And we get a melt-up scenario like the late 1990s that ends badly with a meltdown. And then the 1970s can't be ruled out yet. That's another 20% probability scenario, which would be one where inflation makes a comeback because of geopolitical shocks that cause energy prices to soar. So, put it together and you've got 80% for a bull market in stocks, for the economy doing well, and 20% is the risk that things really go badly.
You made a pretty bold call recently in one of your research notes. You said in our roaring 2020 scenario, the Dow Jones Industrial Average could increase 50% through the end of the decade to 60,000 in 2030. And the S&P 500 should increase 50% as well to 5,000 in this scenario. That's a pretty big move.
It's a pretty big move, but it's really just an extrapolation of the trends we've had as long as things basically go right. That doesn't exclude the possibility of a 10 to 20% correction along the way. It doesn't even exclude the possibility of a bear market along the way, as long as it's not too long and not too deep. I mean, we just had a bear market already for the decade, so we sort of had our quota, if you will, in 2022, and we got through that really well and without a recession at all. So I think there is a potential for the for earnings to drive this market to 60,000 on the Dow and 8,000 on the S&P 500. But clearly, better than expected productivity would make that an increasingly likely scenario.
Eric, I want to get you in this conversation. One of the key points or key assumptions to this roaring 2020s scenario is that inflation does come down to 2%, maybe even lower. What are your thoughts on that? What are you seeing?
Yeah, we see the Fed's PCE deflator, their preferred target, making its progress down towards 2% by year end. And when you take out shelter from CPI, we're already at 2.1 and 2.2 on headline and core. So we're basically there. The key question is, where does shelter go from here? It has a very large weight in CPI, combined about a third. And we see strong disinflation. We're still around 5.5% on a year over year basis. But you look in the last 3 months and you annualize those, you're right around 4.5% or even lower, whether you look at headline or core. So we see encouraging trends. We expect shelter to continue disinflating. So we think progress on inflation is, it looks good. It's moderating.
So I've got a question for you on shelter. You also recently came out with a note talking about 10-year yields. You see 10-year yields probably staying within a range, 4.5 to 5% or so. Mortgages are priced off the 10-year. A lot of debt is priced off the 10-year. What is your forecast for the housing market?
We've seen rising supply, and that's both in the South and in multifamily. I mean, there's even in Texas and Florida, the Wall Street Journal had a story that there was price deflation because of all the supply coming online. So builders are definitely encouraged. Some of the, Toll Brothers, Pulte Group, I mean, those stocks are soaring this year and outperforming strongly. We see supply continuing to grow. There is the immigration question. That's a thing in the labor market that we've seen, right? There's a lot more immigration coming across the border. So a bigger labor force. People need houses to live in. So that is one question in terms of demand. But yeah, we think, while there's a rolling recession in single family, plenty of building is going on. And, we're encouraged by that.
Yeah, and I think people get used to interest rates where they are. I mean, I think more and more people are starting to realize, we're not going back. We're not going back to 3.5%, 4% mortgage rates. And people are getting used to 6.5% to 7.5% mortgage rates. When I bought my first house, I think it was in the early 80s, I paid 16%, and I wasn't the only one buying a house back then. And so I tried to pay it off, but I wound up selling the house and subsequently managed to get a lower mortgage rate as rates came down. But people want to live somewhere, and people who rent at some point get tired of renting and want to buy a house, and they figured out how to manage. And I think there's a lot of intra-generational wealth transfers going on where baby boomers are helping their young adult children to afford the down payment and maybe even make some of the mortgage payments.
I think they might have to. I can't remember the source of this, but this morning I saw a chart. It was talking about how, I think it was 30 years ago, the ratio of median income to home prices was 3.6 times. Right, so a home costs 3.6 times as much as your annual income, and now it's up to about 6.25.
Right.
So it is significantly more expensive to buy a house. Do you see that coming down or changing that ratio at all?
The more we look at the housing market, the more complex it gets. There's so many moving parts in that marketplace between a lot of baby boomers who you would think they would be selling their large homes and trading down. But maybe after COVID, they realized that, if the family comes over, you want to keep the large home. Maybe you want to have one or two home offices in your large home. So we really haven't seen a lot of supply. And supply is still an issue, which is a great opportunity for the builders. And they're responding to that opportunity. So the supply is an issue. And on the demand side, as Eric pointed out, there's a lot going on there, too, with not only immigration, but also migration from the north to the south, and how builders are responding to all that. But at this point, given what we know today, I think part of the problem is some of the, land regulations. The government is the problem in terms of builders being able to respond to the kind of demand that they're seeing.
When rates first dropped so low, we heard about repression of savers.
Yeah.
right? And now rates are back, and if you do have enough money to save and earn interest, it's not bad.
Not bad at all.
It's a unique experience, right? To
Yeah.
be able to earn an easy, risk-free 4.5%.
Yeah.
Not terrible.
Not at all.
Let's move on to some other parts of your thesis here. The U.S. consumer. What's the health of the consumer? Because we're hearing about credit card delinquency rates going way up. You have a little more nuanced view. Can you talk a little bit about that, Ed?
Eric's just done a lot of work on that. Eric, you want to chime in?
Yeah, we're starting to see, and granted, for the past couple of years, people have been talking about the consumer cracking. We had all these excess savings that we built up during the pandemic from stimulus, and then eventually, when those would run out, we'd have to retrench, build our savings back up, and therefore spending would fall. That hasn't happened at all, and rising real incomes have really just supported spending. When you look at credit card delinquency rates, sure, there's a rise, but that rise is really concentrated among maxed out borrowers, which tend to be younger and lower income. So if your credit limit's like, let's say $4,000 to $5,000, which it is for the Gen Z cohort, more of you are going to be maxed out. Credit card rates have risen. Thus, you're going to kind of compound the rate at which you go delinquent. If I was going delinquent X amount of time when rates were 15%, now that my credit card is charging me 22%, I'm going to go delinquent quicker. But still, maxed out borrowers are not even back to pandemic levels as a percentage of overall balances or overall households. So we think that we're settling out actually healthier than pre-pandemic. If you listen to bank earnings or some of the consumer finance companies, they see a lot of health in the consumer. Capital One thinks that consumers remain strong, and as a percentage of disposable income, debt remains at all-time lows outside of the COVID. Debt servicing remains at all-time lows outside of kind of the COVID aberration when there was a flood of cash. JP Morgan, Jamie Dimon saying, hey, the consumer looks great in our opinion, and a strong labor market's driving that. At the end of 2022, he was kind of on the opposite side of that coin, saying, hey, the consumer is going to have to retrench. And also Bank of America came out and said, hey, we actually think delinquencies and therefore net charge-offs are going to level off at a better rate than they looked at before COVID. So everything looks fine to us, and rising real incomes are really kind of putting all that debt in comparison. And we don't see any cracks, especially with this labor market.
Yeah, I think, Ed, that when we look at the consumer, we again come up with the notion that it's a very complex subject, and you can't just generalize about the consumer. As Eric just pointed out, there are different people in different points in their lives with different maximum amounts they can borrow and so on. But we have always paid attention to demography, and I think one of the reasons that we didn't anticipate that a recession would occur is because I'm a baby boomer, and while I'm still working for a living, a lot of my friends are retiring, and I think retiring is a major phase in one's life. Suddenly, you're giving up income to save out of, and you realize that the whole point of retiring was to spend retirement assets, and if you're lucky enough to have assets that are giving you income, interest income and dividend income, you can live off of that. If not, you're going to be tapping into your nest egg. I think the only uncertainty in a retirement situation is you don't know how long you're going to live. So maybe you're a little bit more careful about your spending. But look, the baby boomers, to a large extent, don't have mortgages anymore. To a large extent, they're not paying tuition for their kids anymore. Their costs are really down. And so they're living it up. And they're going out to restaurants. They're traveling, taking cruises. They're checking themselves up with their healthcare providers just to make sure they can go on that trip to Peru and climb Mount Machu Picchu. So they're spending a lot of money. On the other hand, you've got younger people who are stretched. I have 5 kids, and the 2 younger ones are still living at home. They both have jobs, but they're not getting paid enough to really go off on their own just yet. So there's a lot of different kind of stories in the consumer. But when we add it all up, it looks to us as though the consumer is still going strong. And the key there is, you don't get a recession when payroll employment's going up to record highs month after month.
It's funny you say that anecdote, Ed. I mean, I had dinner with friends over the weekend, and those were the stories being bantered around. Like, what we thought we would sell our big house, but it seems like whenever we go to, one of the kids comes home for 6 months.
Exactly.
It's just easier to stay put.
Yeah.
Let's take a quick break from today's interview so I can tell you about Malden Economics' new flagship investment letter called Macro Advantage. This is where my research team and I build a portfolio of ideas that are directly tied to the big themes and trends that you hear me and my guests talk about every week here. We identify the world's top investment themes, and then we build a portfolio around these themes, all while explaining how they tie together and why we make every recommendation. While the research is thorough, we explain our ideas in plain English so you can sleep at night knowing why you're invested. You can learn more about Macro Advantage by going to www.macro-advantage.com. That's macro-advantage.com. Thanks for your patience. Let's get back to the interview. About a year and a half ago or so, Ed, we were talking about a different type of recession. I want to go back to something you said earlier when you said we had our bear market this decade, but we didn't have a recession. But you used to talk about rolling recessions, which I thought was brilliant.
Thank you.
Are the rolling recessions over?
Put it this way: we had a rolling recession in housing. And particularly single family housing. We've got to again be very specific about what we're talking about here. Multifamily has been very strong, though recently it looks as though multifamily has come in some. Maybe it's because rates have gone up, so developers are having some issues, and maybe rent inflation has come down because they have built a lot of units, particularly down south where people are moving to. So I would say that there's evidence that the housing rolling recession is bottoming. Another area where we had a recession was in retailing, merchandise. That's because we had this buying binge for merchandise coming out of the lockdowns. We couldn't go out and buy services because there was still a lot of social distancing restrictions. So it wasn't that easy or you didn't really want to go to restaurants and get on planes and things like that. So people had this tremendous need to feel better after the lockdowns. And there's nothing like shopping to release dopamines and make you feel really good. And so everybody went on a shopping spree. Here at the Ardeni home, my wife in May of 2020 ran out and got a patio set so we could eat outside instead of in the kitchen with everybody that we had over for the lockdowns. And the salesperson told her that she had bought the last set in early May. They just completely ran out. And then by June, we were buying 2 sofas to replace some older sofas in our living room. And then we realized that the colors didn't match the walls, so we repainted the walls. And that was it. I mean, we went on our little buying binge, and now we're going on our on vacations where we're traveling more. We're going out to restaurants more. So I think that's kind of what's going on with consumers, as we mentioned before.
So last question on your on the Roaring 2020s thesis, and then we'll jump into what might shake your resolve from this. But Eric, you've spent some time at the Fed. If you were counseling the Fed now, would you be telling them to cut rates? Do they need to cut rates?
No, we don't think so. I think it's pretty clear that the economy can handle interest rates at 5.5%. I mean, if you think about it, that's kind of where rates have been over the long run, and the economy did just fine. The post-Great Financial Crisis world and then COVID of ZIRP was kind of the aberration, right? So things are going fine. Why cut rates? If they do, it would be to maintain an inflation-adjusted rate that's constant. Inflation is falling, so we have to cut the Fed funds rate to kind of match that and keep rates where they are. If they did that, which we don't think they need to, we'd probably see a higher chance of a melt up in stocks. A little bit more of that. I think you recall in Q4 and heading into this year, the markets really got ahead of themselves, thinking, hey, 6 or 7 rate cuts are on the horizon, and like small caps and meme stocks and everything that was junk just like shot up. So, that's not necessarily a horrible situation. It's one in which, stocks go up and you can ride melt ups. But again, it's not that kind of strong, long-lasting, durable growth that kind of keeps bringing stocks to all time highs more durably.
And this is for both of you. Do you like the market as a whole? Is it as simple as just buy the market and go home, or are there specific sectors that you like more than others right now?
Well, we've been we were early on in the bullish camp. It was November of 2022, early November 2022, that we looked back and said that we thought October made the low in the S&P 500, and we've been recommending overweighting technology, industrials, financial, and energy. Energy is sort of like a shock absorber in case things really blow up in the geopolitical realm. If Ukraine starts more heavily bombing Russian oil facilities, and if the Middle East situation escalates to the point where the oil supplies become an issue, which at this point doesn't look like it's very likely, but it's something we have to consider. But technology has done well, industrials have done well. Technology is all about increasing productivity that's necessary to do because of labor shortages. I was just at a Shake Shack in New Orleans. I don't know why I hadn't been at a Shake Shack for a while, but I walked in there and there were all these iPads where you just order what you want, yourself. There's no order takers, and then there's a little number sign that you put on your table, and then 5-10 minutes later they bring it to your table. So I mean, talk about productivity. It's crazy what's going on. Industrial stocks have done well because of the government spending all this money on infrastructure and onshoring. We've seen construction and manufacturing plants kind of off the charts. I mean, we are building a lot of manufacturing plants, which will make a difference, we think, in our self-sufficiency in some areas. So that looks pretty good. And the financials, when they do well, you typically have a bull market. So we think it's a pretty strong bull market, and we'd stay with all these areas. The problem now is it's like a kid in the candy shop. All of a sudden, utilities take off. We hadn't really thought about utilities as AI plays, but suddenly that's what they are. Investors that we talked to, some of them, when we started talking about copper breaking out and gold and the metals doing well, said, "Well, I wasn't really prepared to invest in metals, but that's what you have to do in this kind of environment." So it is a bull market in almost everything. Eric, you want to weigh in on something?
Yeah, I mean, we're definitely seeing it broaden out a little bit. Everyone talks about the mega cap 8 and what NVIDIA does, but we're seeing, I think that kind of improving across the spectrum. There just hasn't been the same, the higher rates kind of drag the economy slowly through a credit crunch. We haven't seen that. And monetary policy transition stateside has been vastly lower than the rest of the world. I mean, everyone turned up their mortgages or debt. If I'm Microsoft, I have like the inverse model of a bank, right? I basically lent at 4.5, or I borrow at 4.5, or basically I borrowed at 1 or 2 during the pandemic, and now I'm lending at 5.5 through money market mutual funds. Basically everyone has access to that now, households and corporations. So for now, it sounds kind of counterintuitive, but in some ways, higher rates are stimulative, and all those interest costs that we worry about in terms of fiscal policy, the government, basically their second biggest outlay is now net interest payments. Well, that's stimulus to the economy. So for now, it's helping a lot of people.
That's an important point Eric's making. Is it's called net interest outlays, and anything that's a government outlays tends to be stimulative. And so the government is paying out, what is it in Eric? It used to be a year or two ago, it was like 300, 400 billion. Now it's 800 billion at a 12-month pace, and it'll probably be $1 trillion in net interest paid by the government. So, if you want to be pessimistic and bearish, you can certainly find reasons to do that with regards to the out of control deficits and debt. And that's one thing that we can't really put lipstick on that pig. We generally tend to be optimistic. We try to be balanced is really what we try to do. Just we sound like optimists because so many people seem to be perma-bears. So it kind of like locks us into something. When we balance, we come out more optimistic. But better than expected growth because of productivity could delay the day of reckoning. But there could be a day of reckoning with regards to the debt. And our response to that was, well, look, politicians created this mess. If we can scare the living daylights out of them, then maybe we'll get some bipartisanship and they'll do something about it. I mean, it's really simple to get rid of the deficit or to reduce it. All we have to do is increase taxes and lower outlays. But, realistically, trying to get that anything like that in Washington is not going to happen. So maybe there is going to have to be a debt crisis to get these clowns to, sober up.
I love how matter of fact you are, Ed. All you got to do is so you're talking about the 20s or the Roaring 20s, though. But the last century, the 20s didn't end so well, right? With 1929, could that be foreshadowing to the next day of reckoning?
Well, I've done quite I like history. I like economic history. I think to be a good economist and strategist, you have to have some idea of what the history of our economy and financial markets has been. And so I've looked back in the late 20s and early 30s, and I've come up with something that I think is still fairly controversial. It's not unheard of, but I think it was the Smoot-Hawley tariff of 1930 that shut off world trade. You shut off world trade, and guess what? You're going to get a global depression. You're going to get deflation. You're going to get farmers going out of business, banks going out of business because the farmers can't make their payments. And so it was a total and complete disaster. The Fed also made some mistakes along the way at that point. I think de facto we were still kind of on the gold standard, and FDR took us off it for a while. But I think trade issues are back. Clearly, Trump brought trade tariffs back. Biden's talking about those issues. So it seems like tariffs are a bipartisan issue. Both sides apparently can agree on that. Because, look, China has been getting away with, just ripping everybody off, taking advantage of the free trade system. And so naturally there's a backlash against that. So I would say that we want to watch that out as a risk for the global economy. We are seeing the global economy bifurcate between us and them, us being the U.S. and the traditional West, and them being basically what has been called the axis of evil. So that would be Iran, China, Russia. I guess China was never really included in that, but they're certainly on the other side of the fence we're looking at. And that's deglobalization could be a source of inflation and could derail our happy talk about the rest of the decade and make it more like the 1970s, but we don't think so at this point.
So essentially, it's fair to say that geopolitics is the number one risk to your investment thesis here?
Yeah, I think so, because the past couple of decades, globalization was a major source of disinflation in global markets. China prospered, which is great. It was great to see all these Chinese people having better standards of living. And by the way, they did that because the Chinese Communist Party basically stepped back and let capitalism work, and it worked like a charm. And now the Communist Party wants to take control back, and that's starting to create problems for them. China's is a mess, in my opinion, in our opinion. So geopolitics, I think, some people have said there's similarities. Forget about the 20s. Forget about the 70s and the 90s. It's the 1930s. And there's some frightening similarities there.
Eric, anything to add on the risks front?
I think, to quantify one of the points that Ed made, China had a huge recession and the recovery has been non-existent almost until this point. They've exported a ton of deflation to the U.S. If you think about where inflation is, it's all in services. Goods prices are deflating. So any risks to that, wouldn't be great for our inflation picture domestically.
I want to make sure we touch base a little bit on your research shop, Yardeni Research. You have a great product, Ed, that you launched maybe 2 years ago called Quick Takes.
It's at YardeniQuickTakes.com. And we've been, over the years, seeing a lot of requests from individual investors that wanted to get some semblance of what we're doing. They kind of like what they were hearing in some of the news outlets about what we were doing. So just a couple of years ago, we decided to give it a shot. And so we created this Quick Takes product. And what's unique about it, I think, is that it's kind of educational in a way that hopefully you can make money with when you really understand how the economic indicators, domestic and global, interact with the financial markets and how the financial markets might have an impact on the macroeconomic indicators. So it's very top down, but we also teach people about how interrelated markets are, the correlations that exist between copper and oil and some of the equities that key off of that, and how you can use some of these various indicators to really assess, is the global economy getting better? Is it getting worse? Do you want to overweight the U.S., overweight the rest of the world? And so we do that with Quick Takes. We were, on a daily basis, we tell you, here's what we think is important. Give you some charts that kind of, charts worth 1,000 words, and we provide a few of those. But all in all, you can read it in 5-10 minutes, think about it for a little bit, and I think you'll get a better understanding of how these markets work.
Yeah, I like it a lot. I read it every day that it comes out. What I like about it most, I think, is that it's easy to understand. You don't need to have a PhD in economics or finance to be able to understand it, which is very helpful.
Yeah, I think economists tend to, to focus on too much jargon. I mean, look, we're not MDs. We're not doctors. Doctors need their jargon. It kind of makes sense. Jargon for economists makes no sense because it's all about humans. It's about, consumers. It's about businesses. I mean, these are real people, and it's not that hard to use English, simple English, to kind of get in a handle of what we're all doing collectively.
Before you leave, I want to invite you to join my Global Macro Update newsletter. This is a free service that comes out every Tuesday and Friday. I'll send you an email with my latest thoughts on geopolitics, economics, the markets, along with a link to the latest interview and a transcript. If you'd like to join us, hit the link in the description below or go to globalmacroupdate.com and join over 100,000 other Global Macro Update readers. I hope you join us. I'm Ed D'Agostino. Thanks for watching.